One of my favorite high dividend paying stocks, Dow Chemical, DOW. We're looking at it here. It pays 5.2%. That's $2.80 per share per year right now. We look, they've been paying $2.80. That's 70 cents per quarter in dividend payouts. They've been doing that for years. That has not moved. That's a very good sign. It's a nice blue chip. Leave it in the portfolio. Don't have to worry about it. It's only $53 a share, so you can scoop shares easily enough, and you start earning that dividend every quarter, 70 cents per share. So you get a 5.2% return, plus you're holding an asset in that you're holding the shares, which is a staple company. There's not going to be as much movement maybe in terms of the share price and capital appreciation, but this is what we want out of dividend payers. Is a stable company, going to keep paying you that dividend. Cash flows are stable. So Dow, they're in like plastics, adhesives, a lot of industrial packaging and things like that. So fully just baked into the way we live life now. Like their products and the things that they create, the chemicals and solutions and things, they're so used around the world, and especially in just everyday use type of stuff that you don't even know that you're interacting with this type of a company, but they're in all these places. So we like that. They're $37 billion market cap, and everything I'm looking here, I mean, I've had them in a portfolio. They're, positive operating margins, positive profit. Their EPS has been positive since 2020, and shares outstanding has trended slightly lower year over year. So they're, if they're buying back shares, that's always a good thing. But yeah, this is a perfect example of a 5% above 5% dividend payer in a blue chip type of company. This is where you put it in, you forget about it, and it just keeps paying you. It's like, I like to say, like the monopoly piece, the railroads, those types of companies. These are just this basic materials as the sector. So it's like I said, adhesives and plastics and just things that as a consumer we don't think about much, but in manufacturing terms and as far as the way the world works and what things are needed to make things, goods and things like that out of manufacturing and packaging, all kinds of packaged foods and plastics and films. These are the things we use. So love that type of a business because it's going to be here. We're not going to have no need for their products because of technology or something. If anything, they're investing in making advances in terms of packaging and things like that. So there's always going to be a play where new things that come out, the big players are who are going to be benefiting the most. So I like them in terms of whatever we're going to have happen for inflation also, because another like solid playing type, they make a basic material, raw materials in, the input costs might rise as inflation and commodities and things like that rise, so the share price will generally reflect that also. This is again why we invest in stocks, because in inflationary environments, assets and things like that, like stocks, like real estate, they're gonna trend upwards, because especially if there's a dividend paying stock like this, a cash flow associated with it, that's gonna keep commanding a higher price in the market as the dollar gets weaker. Essentially, these things stay a little stronger because they're good for something else. It's a share in a business that earns a profit that pays you. So in a bond or something like that, that's paying you. It's an asset. So these are what we like to stuff a portfolio for the long term with, because year over year, and especially in decades, when you've got things like this paying you 5% every year, just compounding, $50 you put in today, assuming, let's say you hold this 10 years, to just keep getting, you've been paid back for the shares at some point, so now you're just getting like free money back, and you still have the shares, one day in the portfolio, so you see this large principal balance. And that's what you really want to get to, because then the bigger that number gets, the more you can make money with that money. Like, then you start really shuffling this portfolio around to where 5%, 6%, that can make a difference in your income for the year. An extra few grand or an extra few grand a month at some point, because you know how to manage this portfolio and choose these dividends that are coming in to kind of manage your portfolio, manage the account essentially, to produce more cash flow, to produce a higher paying yield or a dividend that obviously you have to adjust for risk and take profits on certain companies when the time comes, but that's what we're after here, building up a solid baseline portfolio. Dow Chemical, I like that name. Put that in there, you're earning over 5%, and you can leave it alone. Talk to you later.